Welcome to the WTR Healthcare Happenings podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. Today, I'm joined by my healthcare equity research colleague, Robert Sassoon, to discuss the biotech and pharma sector, particularly with respect to reinvigorated M&A environment following a lackluster few years on the M&A front. Good morning, Robert.
Morning to you.
So, Robert, walk us through what is happening in biotech and pharma M&A this year.
Sure, Tim. 2026 could be shaping up as the strongest biotech M&A market since the pre-pandemic peak of 2019, marking a sharp regime change from the subdued conditions of 2024. In just over 6 months, 2026 has produced 35 disclosed value deals worth roughly $97 billion, already about 85% of 2025's $114 billion across 48 deals. Now, the clearest signal is in deal size rather than deal count. Average consideration per disclosed deal has risen from 1.2 billion in 2024, the post-pandemic trough, to about 2.4 billion in 2025 and around 2.8 billion so far in 2026, although still below the 3.8 billion average in 2023 and well under the highly elevated 2019 average of 7.1 billion. Both of these years were inflated by mega deals. The 2024 contrast is telling, though. A deal count held up at 39, but every acquisition was relatively small, with nothing above $5 billion, characterizing a market dominated by bolt-ons and rescue transactions. The increase in average deal size is the clearest measure of the re-rating. Buyers are not simply transacting more, they are paying materially more for strategically important assets and showing greater willingness to acquire differentiated earlier stage programs. So unlike 2019, which was skewed by a $74 billion Celgene transaction, a $63 billion Allergan deal, or 2023, which included a $43 billion Seagen acquisition, 2026 has been driven more by a broad-based mid-cap activity rather than a single transformative acquisition. So only 3 deals this year have exceeded $10 billion, the largest being Sun Pharma's $11.75 billion acquisition of Organon.
This is certainly music to the ears of investors in those sectors, which again had a tough few years. So, in your humble opinion, Robert, what reignited biotech M&A after that deep freeze of 2024?
Okay, so the patent cliff has set the scene, but it isn't the whole story, and the data suggests many acquirers would have moved regardless. The cliff is real, don't get me wrong, with some 200 drugs losing exclusivity over the coming years, including roughly about 770 blockbusters. And those include household names like Keytruda, Eliquis, and Jardiance. So we're looking at a cumulative patent loss sales past $300 billion going into the early 2030s. So within the next 7 years, losses running at about two and a half times the prior 16 years. So but the same cliff existed in 2024 when the market was pretty frozen. So it explains motivation, but not timing. I would say the clearest evidence is where the money is going. The majority of deal value is flowing into earlier stage assets, with around 60% going to phase 2 and earlier science. So buyers are simply looking to replace, not simply looking to replace expiring revenue, but rather they're looking to build pipelines for the longer term. So has unlocked the activity? I believe there are 4 factors layered on top of the patent cliff motivation. First, deal making has got whole lot easier. The drawn out antitrust fight over the Amgen Horizon transaction under the Biden administration chilled large US deals back in 2023. Today's more permissive stance under the Trump administration has lifted it, consistent with FTC leadership changes, reducing antitrust barriers. Second, pricing clarity has helped fix the evaluation problem to some extent. The drug pricing agreements struck between pharma majors and the Trump administration have given buyers more certainty on future US revenue, making target assets easier to value and to commit to. So that matters because frozen M&A markets usually reflect a disagreement on price. So the wide valuation gaps that stalled deals in 2024 have since narrowed, as inflated COVID-era premiums on one side and post-crash fire sale lows on the other side have both faded. Number 3, there's a plenty of firepower. Ernst & Young estimates pharma enter 2026 with $2.1 trillion dollars of acquisition capacity. So, for example, even after the 10.9 billion Apogee deal, that's an immunology company that AbbVie has acquired, AbbVie can still deploy over $100 billion dollars in further acquisitions before hitting even a 3.5 times net debt to equity debt to EBITDA ratio. The fourth factor is the improvement in financing conditions and the associated thaw in market sentiment. Federal Reserve cuts have reduced borrowing costs. The XBI ETF has climbed roughly 50% over the past year, and the biotech IPO windows are beginning to reopen. And that will help it restore seller valuations, encouraging cash-constrained biotechs companies to pursue transactions.
Great. So, Robert, wrapping up, what sort of companies are being targeted for transactions? And looking forward, most importantly, which therapeutic areas or structural shifts do you see driving the next wave of M&A deals? And as an aside, given that I recently attended Oppenheimer's excellent CNS and Neuromuscular Summit in Miami Beach, I also have a great appreciation now that CNS is on many investors' radar screens.
Correct. I'll tackle that in a minute, but I think the targeting this year fits a clear archetype. You have a clinical stage company with a single differentiated asset and a clean IP in a high priority therapeutic area. Those are the sort of targets that we're looking at. So acquirers want assets with irreducible biological rationale, not broad platforms necessarily, since platform stories no longer justify premium pricing. The late stage de-risk framing is now only half true, with data showing that around 60% of deal value flowing to phase two or earlier science, as we mentioned. And that compares with a 45% average over the last 5 years. So buyers are reaching earlier than the defensive narrative implies. So in terms of therapeutic targets, oncology leads, followed by immunology and next-gen metabolic and neuroscience. Now, the bolt-on is the sweet spot at $1 to $10 billion dollars with no transformative megadeal thus far in 2026. And as I mentioned, the largest deal this year so far is the Organon deal at $11.75 billion dollars. Now, there are two types of sellers, contested assets at real controlled premiums. We can give you, for example, Apogee at a 49% premium, Arcellx at 79%. And then you have distressed microcaps with exciting assets rescued at optically huge premiums off a low base. So the seller side pressure is structural, with emerging biopharma making up to 70% of clinical stage assets, much unpartnered, and VC funding below average. So it's a really good fodder for the big farmers. On to future trends, the clearest structural shift is the rising role of China, which now accounts for roughly 30% of the global drug pipeline. Western firms are increasingly tapping that science through a new co-model, licensing the ex-China rights to promising Chinese assets and building new US or European companies to take them through the FDA and EMA. So the main complicating variable here is the Biosecure Act, the US law designed to curb American drug makers' reliance on Chinese biotech firms that Washington views as national security risks. And that adds legal and due diligence friction to deals touching Chinese partners' manufacturing or data. Now, the cliff names, Keytruda, Eliquis, Gardasil, Jardiance, will keep oncology and cardio-metabolic placements in demand through the concentrated 2026 to early 2030s window. Now, CNS, as you mentioned, should see a continued strong push with focus leaning more on the neuropsychiatry. Now, of the $27 billion worth of deals recorded in CNS over the past 18 months, the large majority, I would say three-quarters of them, went into novel neuropsychiatric pipelines, though that figure was heavily anchored by J&J's $14.6 billion acquisition of Intracellular at the beginning of last year. But it is an area of real excitement, and this year has brought a couple of positive serotonergic depression phase 3 readouts from Compass Pathways and from more recently from Definium Therapeutics, which should or could potentially trigger for the next wave of neuropsychiatry M&A. So I would also just on top of that, I would also look to AI drug discovery platforms as the next premium category to watch. That seems to be really a really fast growing area amongst biotechs.
Great. Well, thanks, Robert, for catching up with us on biotech and pharma M&A transaction trends. I'm in your camp that I think we're going to see a lot more deals announced over the next 12 to 18 months. And I will say just a passing comment as we wrap up here is that I found it very enlightening speaking with probably two, 3 dozen biotech CEOs over the past year that are publicly traded that openly acknowledge their end game is to get through the final phase of FDA trials and then hopefully be absorbed into a larger firm rather than trying
Yeah,
to go it alone. So have a great day.
yeah, you do. Thanks.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Healthcare Happenings podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.